Alrighty, welcome everyone. Welcome to the trade findings and adjustments for, let's see, I think it's Thursday, the last day of the month, the 30th of September. Glad to have you guys with me, kind of a smaller group. Looks like we got about, 15 of you here today. So let's go through what I'm going to talk about is protection one more time and two ways that you can get free protection. Now, I'm going to start off with this caveat, right? Plain and simple, free protection means you can make nothing or next to nothing on the way up. So there are ways to create 100% free protection. The problem with doing that is that in creating free protection, you are unable to make any money on the way up, or so little money, it might not be worth it. But there are times like 2008 and our next big market crash that what we're going to do will be extremely helpful. So today I wanted to go over protection. I want to go over protection, how it works, and a couple positions that we're on right now. So let's start with right now. Let's talk about deep in the money. And you're going to see that is deep in the money. Covered call, geez, come on. Covered call protection. And I have an example of this. Let me pull this up. I find it pretty interesting because it's something that if you just have no clue, if you just don't know what's going on, you want to make a little money, this is what you're going to use. This is the position that you're going to look at and go, okay, I'm uncertain about the market. I don't like the way things are going. I don't understand the market. This is what we're going to do to create that position as we start off for you. It's an interesting position because normally you want to do it with a profit. Notice that our JP Morgan we purchased for 109.36. We are capping with the right to sell, not the right, the obligation to sell the stock at 157.50. So let's work the numbers. Let's go through a little bit on what we're saying we're going to do here. So we, or I guess you, right? Come on, give me a little spot somewhere here. There we go. So you buy to open stock, and then you have a profit in the stock. In this case, we're showing a cost basis, right, of 109.36. And then you sell to open a deep in the money covered call, which is equal to the obligation to sell your stock at a certain price for a certain period of time. For our typical one right here, for this example, we're trying to get ourselves through earnings through the last month into next month, right? So for this example, we chose the October 21, $157.50. Well, Kevin, how did you choose that? Why did you choose that? Well, at the time, you know, a month ago, right? JP Morgan. A month ago, we were looking at JP Morgan not getting above its pivot point. So we chose the center pivot point, and we did it right around here as it bounced off the 50-day. Came up, we look good, it's coming back down. Not that you're going to see exactness, but chances are it's come up, it's probably going to come back down and test the 50-day or that pivot point right here. So that's what we were looking at, trying to get us through September, October, making the decision that we put this position on. For all of you in JP Morgan, we were making the decision in the middle of August. Middle August, trying to make our decision on, hey, here's where we want to see this be. And the funny thing is, we were making our decision knowing that we're going to have a credit, that almost brings us up to 160. So where's our initial credit? Cost basis, our credit is $2.48, right? So part of our decision-making process was they were going to get a credit of $2.48, 67, which is like selling the stock at 160. So that was how we decided where we were going to put that position at. We decided, hey, you know what? We're going to protect ourselves. We're going to do some in the money. I took this one out of just one account. I'm pretty sure we got over 10,000 shares of JP Morgan spread amongst accounts. But our thought was, we're not going to have rising interest rates. We're not sure where JP Morgan's going. So for the next 10 weeks, we want to protect JP Morgan, but we don't want to pay for protection. In fact, in this scenario, this is a get paid protection strategy. But the problem is, when you protect, when you're looking at a zero risk or something like that, there is nothing to be made. I'm going to go over that here in the near future. But this is a get paid protection strategy where someone paid us $2.48. And it says if we're going to sell JP Morgan for $160. Right now it's trading at 163.80, right? So people are like, Kevin, you're losing money. Again, this is paper money. Really important for people to understand. There's a huge difference between paper money and real money. And there's a lot we can do between now and then as well to increase this. But for right now, paper money, we are protected on JP Morgan. Our calls give us the right to sell at 160. We're obligated to sell at 159.50, so we have a credit there. And most importantly, this protects us down to, this is protection down to 155. At that point, we can't make up any more of the downward movement, but it's a neat strategy because it deepened the money covered call for a 10-week period of time. And again, if you look back at what we were looking at, when we were looking at using this, it looked like we had 50-day support on it. And we were also thinking, okay, it seems like it stops around 155. That was a previous pivot point. So we're trying to protect down to there and then saying, okay, at that point, we could make a change and make a difference. When the pivot point was right here at 157.50, and that's where our short call was for the last 2 to 3 weeks, We sat through that, not worried about JP Morgan at all. And let me go through one other thing. The adjustment, if we don't want to take a profit is rolling up in strike, out in time for more credit. So that's the way that we would run this. If JP Morgan doesn't come back down to 157, it's already dropped, $5. We're wholeheartedly expecting it to drop even farther. So plain and simple, our expectation is that, hey, if it does come back down anywhere between 157 and 160, we'll take the covered call off for a credit. Earnings for JP Morgan are towards the end of October. We'll add the protective puts. We can run it up to the future. So there's a lot of opportunity here that we have to be able to work on JP Morgan and to I don't know. There's a lot of being fluid that gives you the ability to work or adjust the position as the market gives you different things into the future. But yes, there's a way to protect. For us, it was protecting about 10% to the downside. And we were able to protect 10% to the downside with an in the money or a deep in the money covered call, as this turned into. We didn't have to pay for it. We got paid for this protection. And this is going to give us protection out to the October options expiration month. Great way to protect, great way to run a portfolio. Are there any questions before I go into the long-term 100% for a period of time collar trade? Any questions you guys have that I can answer for you here that may help you better understand what's happening and why and all those kind of things? Any questions? Gonna wait a quick second, let you guys have an opportunity to say something. Looks like nothing's coming up, so all right. So, interesting part. Oh, let's get this back. All right, interesting. Here we go. The 100%, long-term 100% protection for a period of time collar trade. It involves stock ownership. Come on, I can still not type. Stock ownership, long put, which is usually 30 to 90 days out in time, and then a leap covered call. Thought process behind it is the leap covered call pays for protection for maybe 2 to 3 earnings cycles. But more importantly, the option deltas make 100% of downward movement. The problem, or the, well, most people's the problem, you are not 100% protected as the long call caps upside movement. So you're not 100% protected up to leap short call. Let's do leap covered call expiration. as the short call, caps upside movement, and the credit gets used up as you continue to buy long put protection. And I was going to show you an example of this one. Let's create one. Let's go to Under Armour. All right, if we were going to do Under Armour, today we could buy the stock for $2.08, right? We could buy it for $2.08. If we took a little snapshot at the analysis, the risk is that you could lose every penny. Every penny you put into it, you could lose. You'd be in trouble. It would be it would be rough, right? You'd risk losing every penny you put into your stock ownership. That is your maximum loss. Doesn't mean you're going to. Usually stocks don't lose all their value, but they lose half of it quite a bit. So what you do is you then add, especially for earnings, right? You add a November 20 protective put. That November 20 protective put costs you between $1.42 and $1.46. As we're buying the stock, we might lose 7 to 9 cents in the stock purchase. But take a look what this does for you on your snapshot analysis. You just took your loss or your risk of a loss down from the 20,000, and now all of a sudden it's down to only 1,530%. Not a percent, dollars. $1,530. You can't make any money until the stock goes up to above your cost basis of purchasing that long put. But your maximum loss, only $1,530, down from $20,080. It's like you just lowered your risk to 7.5% of your total invested capital. What's even neat is you can add one more option that you're going to sell. You're going to go way out there in time at January 24. We're going to do a call somewhere between 350 and 640. Probably it's going to be in that $5 range, right? For $5, we're going to sell a call and give us about $2.50 of upside potential profit. So I'm going to use this screen here to give you a general idea of how neat it is to be in a 100% risk-free trade. Let's work the numbers with it. So again, pretty, I don't know, it's pretty, for me, I like it because it's pretty simple to see, to use, to understand. Come on, I'm trying to grab it, it doesn't want to move. All right, let's work our numbers for this really quickly. You buy to open the stock. and it's going to be at a price basis of, and when we took the screenshot, 210, 211. Let's go 2010, 2011. Let's go the worst case scenario. You buy to open a long put. It's at the $20 strike for, I'm going to go the $1.45. Worst case scenario, right? Your cost basis is pretty simple. You just add the two together. So it's 2011 plus the $1.45, which is equal to $21.56. New risk, $21.56 minus $20 says you have the right to sell. Your new risk is only $1.56, which is roughly equal to 7.5% total invested capital. Now, adding a leap short call gives you roughly $5 of credit to use for 2 to 3 more earning cycles for put protection, right? We've got $5 to use 3 or 4 times at $1.45 to $1.60 to $1.70 to buy that protection. But that protection's out to January 24th, right? Let me go back, see 1 second. The leap is out to January 24, which means we got the October earnings. We've got 4 earnings through 2022, 4 earnings through 2023. We have 9 more earnings until the short call expires. So yes, in this scenario, you've got 100% downside protection. This is great for 2008. When all those poor people watch their accounts go down by half, we're sitting here and we're saying, hey, we might miss the first 10%. The next 40% drop in accounts, we're going to make up every penny, if not more than that. But this only works for those 3.5 earning cycles as we go through Under Armour, and then we've got to start using our profits, right? Our profits of the difference between 20 and 22.50. So this is a great strategy for 3 cycles. On a big down year, this is a strategy to use. But we run into a problem on that 4th earnings cycle, right? The 4th earnings, we only have maybe 50 cents of credit to use to pay for the long put protection. If we want to continue with long puts, we have to come up with cash, which is really equaling or going into your profits of the stock ownership, which looks bad. The bad thing is if you used up and you kept buying for $1.50, and you had what, 9, you cover 4, you might have 5 earnings of $1.50 or $7.50, where if you protected every single earnings after you've already used up all that credit, you're pretty much guaranteed to lose $7 or roughly 33% in this position. That long call has capped you into a position that even if you rolled it out in time, you still have spent that protection on the long puts, which you have to add into your cost basis, which is a little bit scary. But here are the 2 types of protection that's pretty interesting, because one, you can use a deep in the money covered call and protect you 10, 12, 15%, and you get paid for it. But there is no upside opportunity. It's just a credit. It caps you. There is no upside growth or profit. Your best bang for the buck is you put it at the money, or as close to where the stock was trading as where you put it. And you have to be right on the stock going down. Or you have 100% protection, but you got to get out of your positions at the 9-month mark. Hopefully it's up. Hopefully you've made some cash. Hopefully you haven't lost too much on your leap calls. But it's not something you use for the whole time period that long, that leap covered call or short call is out there, because you'll run into it doesn't work. The short answer is mathematically it just doesn't work. You're out of trouble. You're in trouble. You've capped yourself, and every time you add protection, you cost yourself money, and net you're a losing position. I was showing this to you guys because I found a really interesting article. We asked 3 major investors what happens in the next market. None of them see big returns. Obviously, this is their opinion, right? But right now, JP Morgan Chase is under the impression that it's going to go back to a stock picker's market, that the headwinds that we're coming up against are going to make the value stocks, or the stocks with growth opportunities, more important than the market as a whole. Opportunities overseas, they think, are gone. It'll be interesting to see if they're correct. We've kind of thought this the whole time period. We know there's a big crash coming sometime in the future. Unfortunately, what we don't know is when that crash is going to come. But plain and simple, we're in a bubble again. We're in a couple bubbles. We're in an inflation bubble. We're in a stock market bubble as a whole. We're in a easy money bubble. We're in a housing bubble. We have bubbles all over the damn place right now that brings a huge risk to our market. That was why today we were trying to show you a couple things that we can do if the bottom just falls out and we're in deep trouble. Is there one other? I'm going to say, don't forget the laddering, or adding more than a 1-to-1 ratio of long puts, where you have 2 long puts and can make more to the downside than the stock loses. Now, here's the problem. The problem with all of these for you guys. You guys have really small windows. You're looking at stuff day to day, and money managers don't look at it that way. We look at it out to year or years. And let's face it, an up market, lack of volatility, all three of these strategies look like dirt. And they might look like dirt for a day. But it was pretty funny because a lot of people asked me yesterday, why do you put protection back on Boeing? Why are you still keeping protection on Baidu and Disney and Under Armour? Today is supposed to be a down day in the market. We thought, well, maybe we had that down day on Monday or Tuesday when we had our big drop, but today is supposed to be a down day in the market. It's a down day 75% of the time as you're coming to the end of a quarter as well as the end of a month. The good news is usually tomorrow or on Monday, we bounce back and buyers come back in, they reallocate portfolios, and we're off to the races to continue our upside movement. So for that reason, today is a day that we had protection on last week. We had protection on Monday, and we how did I say this? Well, I'm actually reading questions as they're coming in, but the short answer comes down to we're expecting it. It happens this way. It's a down day. You can freak out and get your panties in a wad, or you can wait for the rebalancing to occur today. It's the reason why we kept some protection in place. Come tomorrow, come Monday, people buy back in the rebalancing. Money, new quarterly funds get put into the market, and we typically sit through a pretty weird October, so we're being more nimble with protection as we're looking at people's portfolios. Bill Brander makes a comment, isn't Boeing losing some China business because they have halted Boeing plane purchases? Yes, anytime someone halts Boeing plane purchases, it's an issue. But again, for Boeing, China is an extremely small part of their business. We're talking low single-digit percentage of planes that are being purchased. Would China buying no planes affect Boeing in the scope of their business? It wouldn't. If it was something like Europe or the European Union, or primarily, I don't know, a major airline in Europe or the United States, it would be different. The article that you sent me on China, I haven't gone through all of it, Bill, but from what I've read and what I understand from their Schedule Ks, we're talking about 3% of their current business, which means they have 97% there, and it's somewhere probably between 3 to 4%. So I wouldn't, for me, I'm not worrying about it yet. And let's face it, in all honesty, my opinion, China primarily has not been buying or purchasing new jets. They are the refurbished jets that they end up buying from Boeing. The older models, because we don't want to send our newer technology and our new stuff over to China, period. All right, any questions that I can answer for you? Any questions about protection here that you guys have that I can answer for you when it comes to protection? So while you guys are thinking for a question, let me go back and answer. I find it pretty interesting, Bill. The article that you sent me was a little lopsided, but they're talking about 20 years and a 1.4 you know, $7 trillion opportunity there. But when you have these planes that are selling for 100 billion, right? We're talking about, and I'm going to do rough numbers, we're probably talking about 150 planes over a 20-year period of time. And it's speculation. China, to what I'm seeing on Schedule Ks, the Chinese airlines have yet to purchase more than like $150 billion. And again, they're usually older planes. The smaller planes are regional plane. The article is slanted and the numbers don't add up to what I'm seeing on on their Schedule Ks for Boeing. And to be honest with you, I mean, we're getting 50 to 100 plane orders all at once, and it's going to take China 20 years to do that. So from what I see right now, working the numbers, it's not an issue for Boeing. Not an issue in the slightest. All right, guys. Hey, appreciate you guys being here. Hopefully this was helpful for you. But when you look at some of the positions we're in, I hope you understand the deep in the money covered call protection. Again, we used fluid was my comment I used on our market on Monday. You have to be fluid. If you look at it just one given day, if you don't have a little bit of a perspective to what you can do, you just look at individual positions, you'd think, my God, we're crazy. How did we put 157 calls on it? Wasn't needed. Well, I walked you back through the charts on what we saw. It's like selling it for 160. We're going to have some drops between now and earnings. And it was a way to get paid to protect you guys for a 10-week period of time through the 2 worst months of the year. And we might use the same strategy rolling it out to a 160 for more credit. We might use the same deep in the money covered call protection strategy to get you through the next earnings and out to the end of the year. We'd end up going out to a December. For those of you that have been worried on how bad things can get in our market, here's the 100% protection for a caller trade. But again, you basically can't make money. It's a 2 to 4 earnings cycle, 2 to 3 earnings cycle type of strategy. Very helpful in downward markets, very helpful in market crashes. It's a protection strategy we can use to make up every penny on the way down, but there really is zero upside growth. And then last but not least, the laddering. You can do a laddering of long puts to make up 100% of the downward movement. But then it's really got to move down. Guys, I appreciate you being here today. Hopefully this was helpful. Have a wonderful weekend, and we look forward to seeing you guys next Monday evening. Again, I will not be there. You will find me on the Monday Night Football game with the Chargers and the Raiders. So wish me well. Talk to you guys later. Bye-bye.